Hello and welcome. The topic for presentation is Cash Reserve Ratio or CRR. Let's begin with the definition. CRR or the Cash Reserve Ratio is the amount of reserves as cash which the commercial banks are bound to keep with RBI as a part of their net demand and time liabilities. It is a statutory requirement and also it is fixed by RBI and can be changed frequently or is changed frequently as per the economic conditions prevailing in the country. Now what happens when there is a reduction in CRR or cash reserve ratio? So first thing that immediately happens is that banks will have more money to lend or money supply increases in the economy. Like when CRR is reduced, banks will have to park less funds with RBI and they will have more funds at their disposal to give out as loans. Now this will increase money supply in the system and thereby cause a reduction in interest rates. So an increased supply of money and with fewer goods to be purchased ultimately will contract the demand for money and thereby fuel inflationary trends in the economy. Contrastingly, when CRR is increased, now banks have to keep larger amounts of cash with RBI and they'll be left with less money to play with. So, moreover, as RBI does not pay any interest on CRR balances, so banks they are forced to raise the commercial interest rates, for example, on home loans or car loans or any kind of loans, etc. Now, this ultimately contracts money supply in the economy and thereby decreases inflation. So CRR is the balance is maintained as an average fortnightly balance. That is, this average has to be maintained under all conditions. Though it can fluctuate on a daily basis, but the minimum balance must not go below the percentage fixed by RBI. Also, RBI does not pay any interest to banks for the funds they park with it under CRR. And if banks are not able to maintain CRR, then they will have to pay interest to RBI. So with this, we come to the close of the presentation. Thank you.